Hey everyone, I'm Jeremy Szafron. You're watching Kitco News. Well, first off, let's talk about BRICS Plus, the alliance between Brazil, Russia, India, China, and South Africa. And of course, even more now, representing 40% of the global population and 30% of the world's GDP. Now, this growing bloc has been openly discussing alternatives to the US dollar for global trade, even floating the idea of a gold-backed currency. Now, with more than 30 additional countries expressing interest in joining BRICS Plus, the shift towards de-dollarization is becoming more and more significant. Now, while the US dollar still accounts for about 88% of global FX trades, the momentum with BRICS poses a clear challenge to its dominance. And at the same time, we're seeing central banks globally grappling with slowing economic growth and rising debt. Today, the Bank of Canada made a bold move, cutting interest rates by 50 basis points. Now, this comes as the U.S. grapples with inflation and debt levels exceeding $35 trillion, raising questions about whether the Federal Reserve could follow suit. Now, according to the CME FedWatch tool, markets are pricing in a 25 basis point rate cut in the next November meeting. But could the U.S. economy be headed for deeper cuts? And lastly, all of this is happening just 2 weeks ahead of the U.S. elections, where economic issues like inflation, jobs, and trade policies will be front and center. To help us break down all of this and to understand the implications for the currency markets, I'm joined by Adam Button from ForexLive. You've seen quite a few things here. Welcome, Adam.
Yeah, I mean, it's a lively time in the market, and it's a good time to talk about it. Obviously, heady days for the gold bulls, and lots happening in the macro economy. So let's break it down.
Okay, let's get down to it. I mean, let's start with the situation where the Fed is expected to cut interest rates by 25 basis points in November, according to that CME FedWatch tool I just talked about. But then we've seen this approach, the Bank of Canada taking a sharper 50-point cut here. Do you think the U.S. will follow suit with a bigger cut, or, the inflationary pressure is still too high for that?
Yeah, there was a bit of a thought that they would do 50 earlier in the month, and the data has just been better. And now they were even talk about a pause, but now we've had officials push back on that. They made it pretty clear that 25 is the baseline. But what do we know about Powell? It's that he is willing to cut more and be more aggressive. So if we start to see any deterioration, especially in jobs data, I mean, they're forecasting at the end of the year unemployment to be at 4.4%. It's at 4.2 right now. So it's not going to take much to tilt it up to that sort of 4 or 5 and heading in the wrong direction that would get them to cut 50 again. So, you go where the data takes you right now. There's a little bit of noise from things like hurricanes in the U.S. And strikes. So that makes it a little bit difficult for them to interpret. I'm watching a lot of corporate earnings right now and listening to what they're saying about the global macro situation. And trying to take it from there. But, there is this impetus from central banks right now to get closer to neutral. It's kind of clear now that inflation is at least temporarily under control. And, they don't need to be up above 4%.
Right. Yeah. And of course, we keep seeing these revised data coming in the inbox, too. It's almost like these revisions keep getting worse. But to your point, I mean, it's been quite resilient. I mean, if the Fed doesn't cut as aggressive as Canada, could we see a temporary strengthening of the dollar here? Or do you think that the market expectations of a prolonged cutting cycle will keep the dollar from gaining too much here?
Yeah, I mean, the dollar's moved a lot in the last month. I mean, the market has been trying to get ahead of it. We were pricing in, say, end of July into August, a U.S. recession. And those are the kind of things that we are seeing in Europe, in Canada, in the UK. There has been this disappointment in economic data through much of the world. The U.S. has been the exception. And then it looked like it was stumbling as well. And now the data has turned back to the upside. Plus the Fed cut, and that cut has worked sort of counterintuitively to how you would normally work it in the financial markets, because it's said to the market there's a huge Fed put here. If anything goes wrong, the Fed's going to cut more. They've already cut, and the economy actually looks better than we thought. So you've had this enormous strengthening in the US dollar. Even today, it's up big against the yen. So we're on a nice trend on that in the dollar. I think it's probably up to where it's at the limit right now until we see some weakening, either in things like Europe or further strength in the U.S. economy. But there is the case for a strong dollar right now. People got a little bit ahead of it, pricing in weakness in the U.S., and it looks like an island of strength. Now, some of that is enormous fiscal spending in the U.S., and I'm sure we're going to get to that. But there is a case for dollar strength. Of course, a lot of uncertainty coming up in the next couple of weeks as well.
Yeah, it's pretty wild. I mean, when you talk about the global macro situation, I mean, the IMF, the International Monetary Fund, recently revised its global growth forecast down to 3.2%, obviously highlighting concerns about protectionism and escalating conflicts. But at the same time, global debt just hit 100 trillion this year, with the US and China holding significant portions of that. So, I mean, how does this impact the long-term strength of the US dollar, especially in light of this rising sovereign debt that we keep to be seeing?
Well, it's a real issue. I've been out there for 10 years saying deficits don't matter, and they haven't mattered to markets. But we're at a breaking point here. It's phenomenal to me that the US has had 2 or 3 years of great economic growth and is running deficits at 7% of GDP, which is almost a crisis level deficit. And there's no real scope for it improving under either presidential candidate. And at some point, the market is going to start barking about it, or something will have to be done about that. And it's really, without knowing the composition of Congress right now and the priorities, it's tough to get a handle on. And then you have over in Europe, enormous debt built up as well during the pandemic. And they have some fiscal guardrails that they put in around the euro, and those are just being pushed out. We had the pandemic in 2020, 2021. They're talking about not getting back to these balanced budgets till 2027, 2028. So you wonder how long that can go on or can be justified. But you have to take your medicine at some point. Either you stop the spending and you bring down growth, and then rates come down, or you keep up the spending and you get inflation. And I think a lot of those roads lead back to gold, and that's one of the reasons it's been just a major tailwind this year.
Yeah, no, the gold market has been fascinating. We will get into that because obviously we're watching today as there's been some profit taking. But I want to go back to that debt level. I mean, with such massive debt levels, could we see a point where the US dollar weakens under the weight of its own liabilities? Or do you think that the US has enough economic dominance to maintain the dollar's status despite these challenges?
I think they can keep the party going. If you look at Japan, I mean, it went on for years and it's at just obscene levels of debt. The US can go down that road, but a better question is, will the US go down that road? Right. We had 10 years ago, the Tea Party movement in the US swept power. A lot of those people are still in Congress. And, for the long-term health of the US, they need to bring those deficits down. And, I don't think either presidential candidate is going to make it a priority, but there are people in Congress who would really like to see that happen, and whether they're willing to stand up for that, and then how you do it. I mean, you can do it with tax increases, which are going to hurt growth, or you can do it with spending decreases, which are also going to hurt growth. So at that point, you start to see the US dollar weaken actually when something is done about it. On the other hand, could you get a moment like you had in the UK a couple years ago when Liz Truss was forced out because of spending policies or tax policies that were going to run up the deficit? I think it's possible, but I think it's much less likely than a lot of the people barking at the TV would like to say or would like to believe. We've been down this road for a while, and I really think it's going to be the restraint in spending that hurts the US dollar and hurts the growth outlook of the US.
Interesting. So still a little ways to go. But I mean, Adam, I got to ask you, have you been watching the latest out of Russia? I mean, BRICS continues to gain momentum there, now controlling about 20% of the global gold reserves and shifting a significant portion of trade away from the US dollar. I think Russia already conducting about 95% of its trade in non-dollar currencies. Is this the most serious threat to the US dollar dominance?
Well, it really is. I mean, the U.S. undermined their own currency and dominance by sanctioning Russian assets in U.S. dollars that were supposedly out of the reach or via the SWIFT system. China sees itself in the crosshairs, and China, Russia's not that important outside of oil and some commodities, but China, in terms of trade, is right there with the United States, if not more important to many countries. So they can reroute a lot of the currencies in ways that will work. I think it takes a lot of getting used to for these countries, but if there's a will, they're proving that there is a way. And now you're bringing people like Venezuela into BRICS. It starts to look like a real anti-dollar bloc, despite a lot of the talk in BRICS that this is just a friendly sort of dialogue group. but they're trying to make inroads into U.S. dollar dominance because it doesn't serve their interests working in the U.S. dollar. I don't think a lot of these places are desperate for foreign direct investment like they might have been 30 years ago. There are a lot of ways to achieve growth, and they're looking at just trading with each other and building systems up that way.
Right.
I would say, the number one risk to U.S. dominance, I think, is the intellectual property system. And I think it's the black swan of this century that we allow the world tolerates the U.S., say, in medicine, putting patents, and we have this system where they say, you have to pay these absurd costs. Or in technologically patents, especially with AI, as the future of innovation is all AI. And because your AI is more advanced and patents all the developments that it's made, that you have a royalty on 50 years of that invention, I think that will come to a head. And then you have a real undermining of the U.S. And that's something that the BRICS could do together at once that would really destabilize the U.S. dollar. But the timing on that is highly uncertain.
Certainly, a huge chess game here by Putin. I mean, the West is watching closely. It feels like they wanted to isolate them to the point where, BRICS wasn't going to form and continue to grow. And they're considering a gold-backed currency. I mean, central banks are buying more gold as reserves. We're seeing gold futures hover near record highs, even with this profit taking. Do you think that gold's recent rally is sustainable? I mean, are we going to put a cap on gold's rise in the short term here, Adam? I mean, what are you thinking?
Well, a couple of things. I mean, there's a lot of talk about gold. So one of the things that I'm watching a lot is the sentiment, right? You started to see, I saw Mohammed El-Arian from PIMCO, or used to be from PIMCO, and the FT writing about gold. Some people talking about $9,000 gold. When you start to see those absurd projections, not absurd, but significantly higher than we're at now, it sometimes speaks to a little bit of euphoria in the market. At the same time, it's not like it's the top story on the Wall Street Journal every day, gold. So I don't think everybody is in the trade right now, but in the short term, it's come a long ways. I think there's a lot of buying ahead of the election on, say, turmoil, some sort of violence and turmoil. That's a low likelihood outcome. So as hopefully, the sun comes up on the day after the election, you would see some weakness in gold on a stable, U.S. environment. And that, I think, is probably the short-term risk that I'm most watching. China stimulus is the other big one. I think China has been the big buyer of gold. The central bank stopped in May, officially anyway, but consumers there have been buying and buying gold because they didn't have alternatives. Real estate didn't work. The stock market didn't work until very recently. And I think if there are some real stimulus measures, people in China might take some of the money out of gold, put it into Chinese equities, and or put it into Chinese real estate again. And that may take away some of the tailwind, but it could be picked up by the Middle East, by American investors. It's a momentum trade at this point. But for right now, I'm going to stay cautious through the election.
Okay, I mean, let's talk about that. We're 2 weeks away, which, Adam, I never thought I would say. But I mean, the political landscape is obviously unpredictable here. How do you think the uncertainty will affect the dollar, especially with candidates offering, starkly different economic policies here? Could a change in administration lead to more volatility?
Yeah, well, the consensus trade is that if you get a red sweep, so that's the Republicans controlling the White House, Senate, and the House, that you're going to see U.S. dollar strength. Part of that is the fiscal side, so you see a yields push up or the U.S. borrowing costs push up, and that's going to drag the dollar higher. I'm on board with that. It is a little bit of a consensus trade right now, and I think there's a high risk that you get a divided Congress, and then you get these fiscal hawks coming out again, and that we do see the market pretty quickly pricing in this gridlock in Congress where nothing gets done, and that yields come down and the dollar comes down. That is the trade I think I'd like to make ahead of the election. We'll see how the polls move in the last little bit to set that up. And, from there, you're going to want to see the permutations, even if you have a very, very narrow split. One or two senators or congressmen can make the difference. And it's very hard to predict. And I think we just got to wait and see. There's always another trade. You can try to be a hero here and price in violence or turmoil. In general, these things work out okay, despite all the fear mongering.
Right.
So that's sort of the name of the game right now. There is an argument you could price in a little bit more gold upside in the next week and a half as that sort of fever pitch builds.
Yeah, all eyes on it. I mean, of course, we'll have continued coverage of it here. Let's switch over to that IMF report. I mean, it's warning about a rise in protectionism, which could disrupt global trade. Do you see this, Adam, as having a bigger impact on emerging market currencies or major ones like the euro or the dollar? I mean, could we see a global shift where emerging markets see increased pressure while major currencies remain relatively stable?
Yeah, well, the Mexican peso is a Trump trade right now. Right. That's one he wants to circle back to it again. I mean, he made the deal. It's open for reopen or for discussion again in 2026. It's taking a hard line again. Again, it's very, very difficult guy to predict, Trump. On the other side, if you do see Harris win, you can see some of the relief come out of that trade. And in general, I think that if we do actually get the tariff policy, and I think the market is really skeptical about it. The first time around, it caused a lot of fear, and it caused a lot of hand wringing too in newspapers. And one of the regrets of a lot of traders I talked to is they got a little bit rattled by that. I mean, it's something we hadn't seen in 50 years, so it's understandable. But ultimately, it didn't really move the needle, even on China trade. A lot of just will flow through Vietnam or Thailand now or make its way in anyway. So not a lot really changed. But you go back to that. Well, again, the talk is very, very tough right now on tariffs. So you have to assume some of that is coming.
Right.
But it's always a negotiation. And I think the market probably breathes a sigh of relief either way. But it's not a pretty picture for trying to understand, between Europe and the U.S., there's a lot of tension there, Mexico, and then emerging markets as well, and particularly in China. So,
yeah,
I mean, plans are being drawn up, but it's really hard to plan for Trump.
Yeah, and I mean, some people even argue, if we put in these protectionist trade policies, could a more insular trade approach weaken the dollar's global dominance? I mean, could this be doing the opposite effect here?
Well, that's right. I mean, if you take the long arc of all of this, weaponizing the dollar against Russia, China, being made into more of an enemy, the BRICS kind of coming together, saw fiscal deficits rising, a little bit of instability in politics. All those roads lead to the same direction, and the gold market's been screaming about it at the same time. So it's all in place, and I think we're in a bull market here for as far out as these trends will extend. There are going to be, there's certainly the kind of volatility that could take it back to 2,500. I don't see 2,000 again in my lifetime, barring something nuclear war or something like that. But it's a buy the dip sort of rally. Right. Things get a little bit ahead of themselves, and then you get corrections. But we've seen these corrections, and you think they're going to come and they're going to be pretty big. I mean, China stopping buying officially in May. I thought, wow, that should take it down. It had run from 2,000 to 2,400. It corrected maybe $100. That seems to be around the limit of when the buyers step back in, which is really impressive, and a strong sign.
Yeah, I mean, huge support here, even as we see some profit being taken. Okay, given everything we've talked about, let's talk about this trade. I mean, we got the rate cuts, BRICS, gold, we got debt. Where do you see the biggest opportunities for investors right now, Adam? I mean, are there currencies or commodities outside of that gold that we just talked about that are underpriced and could benefit from all this global, turmoil that's happening currently? Yeah,
I mean, Europe's a mess. I think Japan is in a better place. They have an election of their own coming as well. It's an interesting spot. Again, their currency is in free fall right now, and it's been a very volatile currency this year. China, we're headline watchers, and I think that the edge right now is in watching headlines. So we wait for the economic data, and we'll see where it takes us, because right now the market's gone from the U.S. is going to a recession to soft landing to no landing in about a month. Yeah. And that can change just as quickly again on a couple soft points. I was looking at a lot of comments today from Texas Instruments saying the industrial economy is really struggling. Canadian National Railway saying it's a tough economy out there. And then you have consumer-facing brands not seeing that. Aside from Starbucks, said comp sales were down about 7%.
Yeah.
So I'm looking, kind of trying to find spots where you get a clear picture of where the consumer is headed, because that's what's really held up the U.S. economy. But there's a good argument that people have been restraining spending ahead of the election. Now, you're going to still have half the country angry after the election. So I don't know if that spending comes roaring back anyway, or investment. But it is really an election trade right now, and an economic data watching trade, and a China stimulus trade that can really turn the tide in emerging markets and in commodity markets in general. If China turns on the fiscal taps to the order of a couple $1 trillion, it can really move the needle. And we're not there yet, but the market has priced in the idea that about that much is coming. And so there can be a disappointment trade if that doesn't happen as well.
Yeah. Wow. Fascinating. And of course, President Xi meeting with Vladimir Putin too. I'm sure there will be some announcements. Of course, we'll be keeping an eye on all of that. Adam Button, of course, is the managing editor from ForexLive. Thanks for this, Adam. I appreciate it. Coming on, talking macro, and really understanding where the trade is here. I mean, it's going to be a heck of a next couple of weeks, my friend.
I can't wait.
Thanks, Adam. Appreciate your time. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for joining. As I mentioned, we're going to have more BRICS coverage. Of course, we have the election coming up, more economic data, and some fantastic guests to break it all down. Stay tuned, and we'll see you next time.